Nvidia is now worth 16% of the entire US GDP. That's not a mistake, and it's one reason analysts are whispering about a new kind of bubble forming in big tech. Here's what's happening. OpenAI, Nvidia, AMD, Oracle, Amazon, and others have created what looks like a circular economy of investments. Here's how it works. Nvidia invests in OpenAI. OpenAI buys billions in Nvidia chips. Oracle builds data centers filled with those chips. And Oracle, it gets billions from OpenAI too. Even AMD joined the loop, giving OpenAI stock options in exchange for chip purchases. Case in point, just this morning, Amazon announced a $38 billion investment into OpenAI to buy chips, and Amazon stock went up 6% on the announcement. So invest $38 billion and see your market value go up 162. On paper, everyone wins. Valuations soar and Wall Street cheers. But the problem analysts and commentators keep pointing to is that when you see the same dollars bouncing between the same players, inflating numbers, those numbers may not reflect real external demand. And it raises a serious question. If these companies are all investing in each other, do we still have true price discovery? Or are we watching an AI merry-go-round where the music stops only when investors realize the growth isn't organic? Case in point, it was just revealed via Microsoft's earnings that OpenAI lost $11.5 billion last quarter. Right now, AI requires massive capital and energy, yet profits lag behind the hype. This was often said during the dot-com bubble, and eventually it worked out brilliantly for a few companies like Amazon. But what if there are new models or new chips that prove to be much more efficient, making all these deals look like zeros? Many of these companies dabbling in AI now make up most of the gains in the S&P 500. And now the risks are starting to become systemic. So the trillion-dollar question isn't whether AI will change the world, it's whether the financial world built around it can hold up long enough to find out.